All right, folks, welcome back. This is episode 18 of the continuing series of the ICT 2022 YouTube Mentorship. All right, so we are looking at the euro dollar. All right, so upper left-hand corner is always going to be the daily chart. As you can see here, daily. Now, if you're looking for bias, you're going to start your analysis here. Let's do that now. Number one, the bias is bearish. So if a bearish bias is being implemented, okay, in other words, you're using that in your analysis. You're going through the charts looking for setups that would warrant a short sale on this particular market or this pair in Forex. What I'm showing you here, all of this up to now, if I make a transition to index futures trading, I'll mention certain caveats when it comes to that. But for now, everything I'm saying in this video, until I say otherwise, is pertinent to Forex. Okay, so it's specific to Forex. All right, so bias is bearish, and we're looking at a daily chart. So you start your analysis there. You have a fair value gap here. So it can trade up into that, and all you have to see is that candle traded to there. Now, you can be greedy and try to trade all the way up into the middle point or deep into it, maybe in complete closure. I don't need that. And we're going to bring in the element of time of day and how that helps you decide what you're looking for. Okay, so bearish daily bias, and I'm going through the daily chart and I'm looking at recent price action. So we had this big drop down here, drawing towards this low, and then the next day we had this candle trade up here. So that creates the fair value gap. So ideally, you know, what we've seen here, we had 1, 2, 3, 4, 5 down days. Now there's likely to have a retracement because we've seen it come way down in terms of the range between this low and this high. So what does that make that area down here? Premium or discount? Discount. So as soon as this fair value gap forms, we know that it's likely to see it rally up into this area here. In other words, a short-term little bounce. That occurring and trading back to this candle's high is enough to set the stage for a new round of selling. So you highlight your area on your daily chart, and then look at what we have in terms of targets. This is an ideal scenario, that low. But it's not likely to do that in one day. Can it do it? Absolutely. But look at what is available in terms of targeting. This day here, it created the fair value gap. So that means we can go in and note that low right there. And we'll change it to blue here. Okay? And we're going to put a little line segment here on this daily candle. And we'll mark that one red. Okay, so we have more or less a premium level that's being highlighted. And you can see it touches it, but it actually goes above it just a little bit. And that's all we'll need to justify a framework. Okay, now let me recap real quick. Bearish bias, we're likely to draw down to this low here. Why? Because we had 1, 2, 3 times, like I mentioned on the video on Tuesday, or episode 17, if I'm not mistaken, in this mentorship. So it's likely to draw lower and dig into this low. That's our draw on liquidity on the daily chart. But is that your trade target? No. Not for intraday trading. So you frame your daily highs and lows, previous daily high, previous daily low. So we have this day here, yesterday's trading, or what we would consider Wednesday's trading. And then Thursday's trading, we opened here, we rallied up, popped just above that short-term high. And now because we've seen that, we can target that daily low right here. Okay, so this is the trading day on Thursday. We open, rally up, create a Judas swing, run back into this fair value gap, and then expect it to sell off. And then we can aim for that daily low. Why? Because anybody that went long in here, who would want to do that? There's always buyers and sellers. Okay, so we're going to use previous day's highs and lows like institutional mindset traders do. There's lots of liquidity around daily highs and lows. And high-frequency trading algorithms attack previous day's highs and lows. If you were back in the baby pips days when I came on the scene, 2009, 2010, that was the first lesson I started talking about, is highlight the previous day's highs and lows. And do that for the last 3 days. If you do that, you'll see a plethora of setups that you can do. And that gives you liquidity pools that you can attack. There's always a fresh supply of new setups. If you're looking at the last 3 days highs and lows, it's always the case. It's always going to be there. You're never going to run out of trades, ever. Okay? So we have our framework here. We have actually, let me change this with blue to that green. Okay? So we have premium and discount. So these two levels are represented on the high and low of Wednesday's trading, which would be yesterday's trading. In other words, your chart would have looked like this. Wednesday going into Thursday, before Thursday started trading, you'd have this. So you would mark your chart out like this. So if we go up here and we enter this fair value gap, that's your opportunity to go in looking for shorts. Then if it starts to go down, you're targeting this low with the expectation. Why is it likely to do that? Because it may want to go down to this low, but this gives you a nice range of profitability, potential profitability. So a range of, we'll just call that 935 to a low of, what is it? What's the low here? 74. So 25, we'll call it 60 handles. Okay, not bad. That's a pretty respectable range. Can you get 25 pips out of that? Can you get 30 pips out of that? How about 40 pips? Well, we're going to find out. But this is the range of opportunity that exists looking at Wednesday's trading. And then Thursday we open, we rally up, we bump that high like we would expect, trading back into that fair value gap, and then we watch price. Does it give us a setup? What setup? Well, I've taught you in this mentorship. So in here, it's this imbalance on the daily chart, but now we can see it also exists in the hourly as well. So we have what? This high and this high. What are they? They're relative equal highs. Anchored to that point right there. Okay. So usually in my annotations, I'm going into the chart. And this is for the purposes of showing you how to backtest and how you annotate your chart. You toggle it to show on the top left, and you can use whatever color you want. And there you go. So we had the annotations that would be on your chart for logging purposes for your study journal. And then you would just screenshot this. Okay, you might want to zoom in a little bit, make the chart a little bit more aesthetically pleasing. Having something like that, more information zoomed in to a specific area. And then simply go in and start working with the 15-minute time frame, because this is all I would do with the hourly chart, because the frame of reference is that daily fair value gap. We have liquidity pool on the hourly chart. We've already mapped out the 6th of April's low. Notice there's no lower low. This low didn't go down to it. And we start a new day on the 7th here at midnight, New York local time. What do I mean by New York midnight? I'm going to answer that. Let's go to the 15-minute time frame here. And you can see we already have that little annotation updated on the 15-minute time frame. So now here's the 15-minute time frame. And I apologize for all of you that would otherwise know how to do this, but obviously it's a mentorship, right? And there's a lot of people in the comment section that are asking for these types of lessons. And once I go through this episode, we won't ever have to revisit it again. Okay, so bear with me, okay? All right, so now we have, on the 15-minute time frame, we're going to annotate the daily dividers. This is a little vertical line. So you're going to drop a vertical line here to delineate a new day at midnight. What is the opening price at New York? Midnight. That's this candle, and you highlight that, and this price right here, that right there, if you're looking at the time frame on the hourly, that would be the opening price. I'm interested in that on a 15-minute time frame, or if I'm going to be scalping, I'm going to use the 5-minute chart. Okay, and I'll put 2 reference points on the 5-minute chart. But for the sake of this discussion, just know that that's the actual price I'm looking at, and I'm drawing that out in time. How far am I drawing it out? 11 o'clock in the morning, New York local time. How do I know my chart's going to look like ICT, right? That's what you're asking. You toggle it to New York. I don't care where you live. I don't care where you're at in all the different time zones. Your trading view chart needs to be set to this. If you do that, your chart will match all the things I'm teaching, and the things I'm teaching you to look for will be easier to find. Okay, everything will be streamlined in terms of time of day. All right, so now we have the buy-side liquidity pool, the daily delineation of midnight New York time, and we're going to take a little line segment here, and we're going to plot it right on here. Now I'm just going to rough it because it's basically a little tiny indecisive candle. I don't care the difference between the actual open and close. It's very minute. But I'm going to draw that on here, and if you drag your your trend line over to the right. If you hold down the shift button, it'll keep your trend line straight. Okay, just drop it there. And I'll just make this a gray color here. Now you can annotate that, but over time doing it, you'll just know that that's what you're anchoring and showing. This is the opening price at midnight. Okay. Now, we have the relative equal highs here. We rallied above them. Once it hits this, do we get displacement? Now we get down to the nitty gritty. Okay. We have a swing low here. It breaks down below that. And then once it does that, does it create an imbalance? Is there a fair value gap? Hint, hint, nudge, nudge. You see that? All right, so we're going to annotate that. So inside of this range here, we have a fair value gap. And I'm going to highlight this. We'll just use this color here. Now, these are probably not the best colors. You're probably cussing me right now, saying, why are you using these ugly colors, ICT? And it's mainly just to annoy you so that way you can get more attentive and pay attention, because this is a long video already. So we're looking at the market wanting to go higher first to go lower. And here's that midnight delineation, starting a new day. We rally up and then we break down. So what's the model teach? Trading when? The New York session. Okay. So we're trading the New York session. In Forex, it's 7 o'clock in the morning to 10 o'clock in the morning. Right there. Okay. So 10 o'clock in the morning and 7 o'clock. So we're looking for a setup that would be formed within that time frame. Now, you can create kill zone windows, annotations on your chart. There's lots of ways I've done this over the years. You can do it whatever way you want to do it. Inside center, and we'll make it black. And there you go. So the New York kill zone, it runs up into that, runs the highs, and we want to see a displacement to the downside. We get it right there. Okay. So now you have this area here, and then you would put your order in right there. What time is that? It's 10 o'clock. So you put your limit order in to sell short right at that price right there, or plus 1 pip, period. And your risk is going to be above this high. The imbalance is really stretched out. You can use that as your stop. If you're really concerned, you can put your stop above the swing high. But whenever you have a big range like that, my stop can place right there. So your stop would be here, and you're going to go short here. That's the minimum expectation using the 15-minute time frame. But we're going to split the 15-minute time frame down into 5-minute intervals. Okay, so we're going to look inside this range here and see if it's advantageous for us to go down into a 5-minute chart. And does it have a fair value gap in that? All right, so we're looking at the 5-minute chart now, and it's that shaded area here. So it's using this specific candle, or that low. And we're looking inside this range right here. Okay, so it's this decline we're looking at. Does it have fair value gap? Well, we have this small one right in here. See that? We have this stretched out one here. Yes. And we have all this run in here where it has a small little fair value gap. So now think about what's been shown. On that 15-minute time frame, we have a minimum threshold of at least reaching into this low. Okay, remember I showed you on the 15-minute time frame that imbalance? So it needs to get up into that. Okay, so I'm answering the question I saw, or it really wasn't a question. It was someone trying to make a point that, was I showing something incorrectly by showing a higher time frame fair value gap? Because wouldn't the smaller time frame fair value gap form before the higher time frame? No, it never works like that. The higher time frame imbalances are going to be parent to the subordinate smaller time frames. Okay, the parent, okay, is this 15-minute time frame imbalance. So it needs to get above that. But when it does that, we have to look at the lower time frame below 15-minute time frame, which is the beginning stages of our fine-tuned entry of 5, 4, 3, 2, and 1 time frames. So here we have the 5-minute chart. We have an imbalance right here, and then we have this smaller one right in here, and all the way up to this price point here, we could factor that in, but it's not likely to get up there. So we can look at what? This level here. That is the minimum expectation. You can put a sell limit order there to go short, or you can fine tune this to rebalance all the way up to here, right there. In other words, it would look like this. This would be your imbalance on the 5-minute chart. And if it traded up into that right there. Okay, in other words, you could use any specific price in this range here you can pick. This is where the unique style for you comes in. If you get greedy, you may not get your fill. But long story short, this would be your range you can work within, and it trades up into that secondary fair value gap. Now, some of you might say, well, what happens if I put a limit up here? Well, that would be obviously a stellar entry, but you don't necessarily need that, okay? Why I like this one is because if you look at the 15-minute time frame, it was like this. That was the range, okay? So if we go up in that range to the upper end of it, look over here. What do we have? All three of these candles here. 1, 2, 3. The order block begins with this candle's low. It's 1, 2, 3 candles making one consecutive bearish order block. So the logic is we ran up into this daily fair value gap. That's what this level is up here. This red line was those relative equal highs on the hourly chart. Remember that? And you're probably going to need to watch this video a few times because I've gone through a lot already. But I'm breaking down the market. And this run here is the run into that imbalance and above the relative equal highs. So this is the bearish order block. It's the consecutive run on this time frame, the 5-minute chart. It does not need to get up into this last up close candle before the down close, because that's what everybody says an order block is. It is not that. Notice it doesn't even get up to that, does it? Why? Because what I'm showing you here. What makes an order block valid? It has to have an imbalance. Without the imbalance, there is no order block. That's why it's not supply and demand. Okay, there are specific rules. I'm going to cut through candles. Supply and demand requires fresh zones. Okay, that's nonsense. I have no affinity for anything like that. I'll cut through fractals and go through and find something over here and still trade on it. So that violates the supply and demand theory right there. So that's the distinction and why I laugh at people that say, oh, he's teaching really nothing new. I'm really teaching you something that no one's talking about. Unless I talk about it first, they're saying what I said. And not to sound egotistical, I'm not trying to be egotistical, but I want you to learn it correctly, folks. Okay? I only want to see you do it the right way. Because if you do it the right way, you will find the results you're looking for. If you don't want to do what I'm teaching, you're not going to be consistent, you're not going to find longevity, and you're going to get frustrated, and you're going to think that this stuff doesn't work because you didn't learn it properly from the person that created it. The order block is all 3 consecutive candles. The reason why this last up close candle is not even traded to is because the higher time frame parent imbalance, that 15-minute time frame, which is being shown here, that range of that low and that candle's high here, it stops there. So there's no necessity for it to trade up into that last candle. So if it trades up into this candle here, the bottom one, the last one of the 3 going up, that's enough for me, and take that over here, and then we have this imbalance. So in my mind, this imbalance is sufficient. We don't need this one, and you wouldn't expect that last up close candle to be traded to. So this is the ideal scenario that I think the mentorship on YouTube should be looking for. Now, as soon as you have this, this is when you settle in on, what are you met with? Another little fair value gap right above it. So what were the rules that I gave you when it has that in the chart? Think. It is going to be a likelihood that it could trade up in there, but your limit order to enter is down in here. Because it might not get up here. What am I trying to do? I'm trying to teach you how to avoid missing trades, because a lot of you are going to want to put an order up in here, and yes, it would have been filled on this instance, but many times you're going to have an order placed at a really overzealous price point that if you nail it, it's beautiful, but they don't happen a lot. It's fleeting. It happens once in a while. So I'm trying to give you something that allows you to operate consistently, gives you lots of setups that will allow you to practice, also back test like I'm showing you here. It's just how you back test, because this has already happened. But these are all the things that I'm teaching you in this mentorship, and I talked about this level here in my own private group beforehand. And you also knew about the bias being bearish on this pair from Tuesday's trading, or Tuesday's episode in this mentorship on the YouTube channel. Okay, so we had a break in this low here. So there's an internal shift in market structure. It's bearish. We have the imbalance here that's been refined down into the 5-minute chart in concert with the bearish order block, the lowest down close candle. We've talked about why we're not looking at the last up close candle before the down move. So we're canceling all that misconception. And it runs up into the level with the rule I gave you. If we settle in on a fair value gap and it has a small one above it, expect that it might trade up there. So your risk has to incorporate that. So that's the reason why I'm telling you your stop loss could be here. Yes, it might be a little bit too rich for some of you because you want to trade with 1 pip stop loss, a half a pip stop loss. There's a lot of guys out there trying to do ultra short-term stuff. You might be able to pull it off once in a while, maybe, a series of trades. But I promise you, when you start putting down size on these trades, you're not going to be able to pull that off. Okay, it just isn't going to happen. So don't get used to trying to do it. Okay. Plus, it's easy to do other things. You can walk away from the charts and not be chained to it, because if you have a small, ultra short stop, I don't care how good you are, you're going to sweat it. You're going to be expecting you're going to get stopped out. What happens if it stops me out? I'm not worried about getting stopped out. I'm not worried about if the market moves to my stop. I'm more interested in the market moving where I think it's going to go. Where is that? That's this level down here. That's the 6th of April's low. Okay? Yeah, we went lower than that already here. Let me get this thing out of your way. If you take this and move it out of the way here, we have an early run at 5 o'clock or so in the morning, and then that at 5:25 New York local time in the morning. It swept the previous day's low. So the 6th of April was swept. Then we rally up and we hit the level that our bias called for. In other words, I'm looking for this level to be traded to before I go short. So I'm not taking anything in London. I'm not worried about anything in London because London didn't give me the initial rally higher into this area. When does it go up here? It's going up there at 9:30 in the morning New York local time. So it hits that level. It's at a really rich premium. And I know my discount level I'm looking for targeting. So here's the framework to set up. We have our market structure shift. We have disqualified all these upper candles here. The lower candle, that's where you're going to aim for. What's the order block that you trade for, Michael? What's the right order block? How do I pick the right order block? I just answered it. What is an order block? It's a change in the state of delivery. The algorithm changes its state of delivery. As soon as we get below, this candle's open. The market starts delivering sell side. And then it breaks this swing low. So now we have changed gears internally. Any rally after that is just setting up another run to go lower. So in other words, this is a suspect rally. Okay? So this is an intermediate term high. Swing high, because it has the imbalance. It should not trade higher than a high. That's the reason why I'm telling you, you can put your stop loss there. See how the rules are coming together? I'm not complicating it. I'm literally telling you everything I've taught, and I'm putting it into the chart. Everything was said before it happened. And here it is. It's the framework. It's the logic. And I'm teaching you with great detail that you otherwise would have never learned. So I'm taking you in over top the chart, giving you the framework and giving you the logic. I'm giving you the what if this, what if that conditions. Okay, I'm telling you how to negate certain order blocks that you would otherwise expect to see a trade to because of different YouTube channels or other people trying to teach my stuff, and they don't know what they're talking about. Okay, they have no idea what they're doing. This setup here gives us a nice opportunity to get short. So you could be a seller here on a limit entry. So you place your limit order here and you just walk away from it. You let it go. Now, what happens if it doesn't fill you by 11:30? Pull the order. It's it. Don't put it good till cancel. Just pull it, because you want to be entering on the day that it creates this. Because relative equal highs, if it doesn't drop off, it could come up at a time of day where you don't really want to be there, and it could fill you and then keep on running and take out the relative equal highs at a deeper pass and then stop you out. So it's important to know why the kill zones are there. Kill zones are when you determine your entry and you place your orders and you walk away. You don't need to have your entry filled inside that kill zone window. Your order idea and your order placement needs to be considered at that time. If you can't derive a order placement for setup or trade entry by that time, you have nothing to do. And that's it. You've basically taken no risk on, and you have to wait till the next trading opportunity or trading day. And then the market obviously starts to break lower and then trades to it here at 245. So at 245, it fills it, and that's the end of that. So not bad. It's 10, 20, 30, 40 pips. So there you go, 40 pips.